Welcome to the deep dive. We're here to help you get up to speed on the big issues.
That's right, giving you the insights you need.
And today, it's a really important one, fiscal dominance.
Mm.
You, our listener, flagged a great report, Full Steam Ahead, All Aboard Fiscal Dominance by Sam Callahan for Lynn Alden.
Yeah, and also some clips from Sam's interview on Natalie Brunell. Good stuff.
Definitely. So our mission today, we want to break down what fiscal dominance actually is.
How it's different from, the usual monetary policy focus.
Right, what it means for inflation, for the economy, and maybe what are the ways out, if any.
Okay, let's dive in.
So fiscal dominance, maybe start with the basics. Fiscal versus monetary policy.
Sure. So you've got monetary policy, that's the central bank, the Fed here in the U.S. Think interest rates, QE, QT, reserve requirements, their toolkit.
Right, managing the money supply, inflation, that kind of thing.
Exactly. Then there's fiscal policy. That's the government side. Congress, the Treasury.
Spending decisions, taxes, deficits, how much they borrow.
Precisely. And fiscal dominance. Well, that's when those government fiscal actions, the spending, the borrowing, become the main thing driving the economy.
So they sort of overshadow what the central bank is trying to do?
That's the idea. It kind of pushes monetary policy into the passenger seat.
Which is different from what economists usually call monetary dominance.
Yeah. Monetary dominance is kind of the textbook scenario. Often when debt to GDP is low, deficits are manageable.
And the central bank can act independently, focus on inflation and jobs.
Right. They don't have to constantly worry about, how their rate decisions will affect the government's ability to pay its bills.
But under fiscal dominance, the Fed has to think about that because the government debt is so high.
It certainly seems that way. If the Treasury is carrying a huge debt load, the Fed hiking rates significantly. Well, that directly blows up the government's interest payments.
So the Fed might feel pressured, maybe even subtly, to keep rates lower than they otherwise would, even if inflation's still humming along.
That's the core tension.
Yep.
It limits their independence,
Yeah.
potentially. And this shift, it's really interesting.
Yeah, because many of us remember the QE years, right? That was all monetary policy.
Purely monetary, yeah. But this fiscal influence, it's a different beast.
So the report's main point here is what? Government borrowing, crowding out private?
Essentially, yes.
Yeah.
The idea is the government is borrowing so much money, think trillions, that it's soaking up available capital.
Capital that private businesses could otherwise use to borrow, invest, expand.
Exactly. It sort of elbows the private sector out of the way in the borrowing market.
And that makes the Fed's main tool, interest rates, less effective at cooling things down.
Right. Because even if the Fed raises rates to make borrowing more expensive for businesses and consumers,
the government is still spending massive amounts, fueled by its own borrowing, which keeps stimulating the economy anyway.
Precisely. And worse, raising rates actually increases government spending via higher interest costs on the debt.
So the argument is, these huge ongoing deficits are the real engine of inflation right now.
That's the central argument from Callahan's report, yes.
Yeah.
And it limits the Fed's options.
Okay, so context is helpful here. How does this compare historically?
Callahan brings up World War II. That was like the classic example of fiscal dominance.
The war effort was everything, right?
Absolutely. The government needed to fund the war, period. So the Treasury basically told the Fed, you need to cap interest rates on government bonds, keep our borrowing costs low.
Direct control. Fiscal needs dictating monetary policy.
Textbook case. And unsurprisingly, it led to pretty significant inflation after the war.
Okay, now contrast that with the 1970s inflation.
Right. Callahan points out that was different. The main driver then wasn't massive government deficits.
It was more private sector borrowing, baby boomers buying houses and stuff.
Yeah, demographics played a big role, a surge in private credit demand.
So when Paul Volcker came in and jacked up interest rates,
It worked because he was directly targeting the source of the problem, that private borrowing boom. He made it expensive and it cooled off.
but the key difference now...
Is the debt.
Yeah.
Back in the 70s, U.S. debt to GDP was what, around 30%?
And now...
Now it's about 120%. A completely different world.
Wow. Okay, so that massive debt changes the whole dynamic. Let's dig into these current deficits. We're talking 1.5, maybe $2 trillion a year added to the debt.
Huge numbers.
How exactly does that fuel inflation? What are the mechanics?
Okay, so the government runs a deficit. It needs cash. It issues treasury bonds.
And who buys these bonds?
All sorts of people and institutions.
Yeah.
Regular households, pension funds, banks, foreign investors.
Callahan also mentioned stablecoin issuers.
Yes, that's a newer element. They often hold treasuries as reserves for their dollar-pegged tokens.
Yeah.
Shows a broad demand.
Okay, so the government sells the bonds. Then what?
Then the government has to pay interest on those bonds, the coupon payments,
Right.
and those payments flow out as income to whoever holds the bonds.
Ah, so it's like a constant drip of money going back into the economy, even if the Fed is trying to tighten.
Exactly. It acts like an underlying stimulus.
Yeah.
And with the total debt now around, what, $36 trillion?
That's a lot of interest payments flowing out.
A massive amount. And think about the implication Callahan raised.
The interest expense itself,
Yeah.
becoming a huge budget item.
Yeah, the second largest line item now. Bigger than Medicare spending, bigger than defense spending.
Just paying interest on past borrowing. That's sobering.
It really is. It raises questions about priorities.
Which brings us back to the Fed. Why aren't the rate hikes working as well as maybe expected?
Well, as we said, raising rates actually adds to the deficit because the government's interest bill goes up.
So it's kind of counterproductive in this specific context?
It can be, yeah. It fights inflation on one hand by trying to slow private borrowing, but potentially fuels it on the other by increasing the deficit.
It does make you wonder, the Fed has brilliant economists. Why stick with a tool that seems maybe blunted?
That's the million-dollar question, isn't it? Maybe their models don't fully capture this high debt scenario.
Or perhaps they feel it's the only tool they really have, even if it's not perfect.
Could be. Maybe they hope it eventually bites, or maybe they're constrained in other ways. It highlights the limits of monetary policy when fiscal policy is pushing so hard in the other direction.
Okay, so if raising rates is tricky, what about the opposite? Lowering rates. We heard Trump suggest this. Callahan discussed it too.
Right. Lowering rates would certainly help the Treasury. You would reduce those massive interest payments, shrink the deficit somewhat.
But wouldn't that be the Fed explicitly helping the government manage its debt? Like pure fiscal dominance.
It could certainly be interpreted that way, yeah. Especially if inflation is still above target.
And the risk. I mean, the usual reason to cut rates is a weak economy. Cutting them now could just reignite inflation, couldn't it?
That's the big worry. Lower rates encourage private borrowing, potentially adding more fuel to the fire the Fed's been trying to put out.
So they're really in a bind.
A very tough spot. Raise rates, hurt the Treasury, maybe not cool inflation enough. Lower rates help the Treasury, but risk more inflation.
Which brings us back to Callahan's main point. The underlying issue is the government spending itself.
That seems to be the core conclusion from the report. Until the deficits are addressed, monetary policy is fighting with one hand tied behind its back.
Which leads to ideas like DOGE efforts to actually cut spending. But then the immediate counterargument comes up.
Isn't all this government spending actually propping up the economy right now?
Exactly. If you cut it drastically, wouldn't that cause a big slowdown, maybe deflation, asset prices crashing? Things policymakers usually try hard to avoid.
It's a very real concern. A sharp cutback could definitely trigger a deflationary period, market turmoil.
Because asset prices have been boosted by all this liquidity.
To some extent, yes. Callahan did note that asset holders have been major beneficiaries of this whole dynamic.
But the argument for cuts, like with DOGE, is that maybe we need some short-term pain. And the Fed could step in if things get too chaotic.
That's the theory, yeah, a kind of reset. Go through a rough patch to get onto a more sustainable path, less reliant on government deficits.
But Callahan raised a crucial point about the U.S. economy being financialized. What does that mean in this context?
It means our economy, and crucially, government tax revenues, are heavily reliant on the performance of financial markets, stocks, bonds, capital gains.
So if spending cuts cause asset prices to fall.
Then tax revenues also fall. Capital gains taxes dry up. Income taxes might dip if the economy slows.
So the spending cuts could be offset or even overwhelmed by falling tax receipts, potentially making the deficit worse.
It's a definite risk in a highly financialized system like the U.S. It's why comparisons to, say, Canada or Germany implementing austerity aren't straightforward. Their tax bases and economic structures are different.
Okay, that makes sense. And then there's the elephant in the room. Entitlements.
Social Security, Medicare, Medicaid,
Yeah.
huge spending categories.
And politically. Well, touching those is incredibly difficult. Callahan mentioned this too.
Very much so. And these contribute heavily to what we call structural deficits.
Meaning deficits that exist even when the economy is supposedly doing well, like with low unemployment now.
Exactly. They're baked in, driven by long-term trends.
Like aging demographics.
Rising healthcare costs.
And the compounding interest on the debt we already have.
Right. Put it together, mandatory spending, mostly entitlements, is what, 61% of the budget?
Wow. Plus interest expense at around 16%.
So you're already at nearly 80% of the budget. That's very hard to change quickly.
And even in the remaining discretionary part, about half is defense spending.
Which is also politically sensitive and likely to increase given global tensions.
So the actual pot of money available for cuts is pretty small.
Callahan put it at maybe 13% of the total budget, or under $1 trillion.
Yeah.
Far short of closing a $2 trillion deficit.
He even mentioned firing all federal workers only saves maybe $200 billion.
Yeah, that illustrates the scale challenge. You can't just trim around the edges.
And the underlying math for Social Security and Medicare, it's just not working long term.
Fundamentally, no. Fewer workers paying in per retiree, drawing benefits. People living longer.
The ratio is just getting worse.
Yeah. And it's crucial for you to understand, Social Security isn't a savings account with your name on it. It's pay as you go. Today's contributions pay today's retirees.
And the system wasn't designed for today's demographics?
Not at all. The projections show insolvency looming, maybe as early as 2034 for Social Security.
Which means something has to give. Tough choices ahead.
Inescapable, really. Callahan mentioned ideas, like those from Stanley Druckenmiller, about reforming entitlements, maybe means testing benefits for wealthier retirees.
Yeah.
Politically hard, but maybe necessary.
Finding waste in defense, other areas.
Always possible, though again, the scale might be limited compared to the deficit size. Yeah. But Callahan really emphasized the best path forward.
Is growth. Growing the economy.
Exactly. Increasing GDP, the denominator in that debt to GDP ratio. If the economy grows faster than the debt, the ratio improves.
But it has to be real growth, right? Not just inflation puffing up the numbers.
Crucial distinction. We need genuine productivity gains, not just nominal growth fueled by more deficits and inflation, like we saw in Turkey.
So how does Bitcoin fit into this? A listener asked about it contributing to a productivity miracle.
Right. Callahan's argument, building on others like Jeff Booth, connects savings to productivity. He suggests savings might be a better measure of real economic progress than GDP sometimes.
Okay.
Productivity comes from the workforce its size and how productive each worker is. Demographics challenge the size part.
So we need to boost individual worker productivity.
Yes, through education, skills, maybe AI helps their most someday capital investment tools,
Right.
but critically through innovation.
And innovation requires what? Risk-taking, long-term thinking.
Exactly. And the argument is that a sound savings technology, something that holds its value reliably over time, unlike cash being debased by inflation, encourages that.
So if people can save in something like Bitcoin, they feel more secure, more willing to invest long-term in new ideas, start businesses.
That's the core idea. It provides a stable base. Callahan contrasted it with the internet-era big productivity hopes. But the measured gains were maybe disappointing, possibly stolen, as Booth argues, by monetary manipulation like QE.
So Bitcoin is seen as potentially enabling real savings, which fuels real innovation and productivity.
That's the potential role Callahan envisions for it, yes. A tool for long-term orientation.
Interesting. Okay, shifting gears a bit. Tax policy. A listener believed lower taxes boost growth. Trump mentioned cutting income tax.
Yeah, historically, the U.S. didn't always have a federal income tax.
But cutting it now, wouldn't that just blow up the deficit even more short term?
Almost certainly, yes. Significant revenue loss. Callahan seemed to agree with the general principle long-term, less government intervention, more capital for entrepreneurs is usually good for growth.
But the immediate fiscal hole is the problem.
Right. Trump also mentioned tariffs, taxing imports, as a way to maybe replace that revenue. Callahan noted some research suggesting tariffs aren't always inflationary, but it's complex.
The bigger picture seems to be boosting the private sector, the working class, especially since we've lost a lot of industry.
Definitely. Which ties into reshoring, bringing manufacturing back.
But that's inflationary too, right? Moving away from cheap global labor.
Likely, yes. It reverses decades of deflationary pressure from globalization. Plus, it bumps up against the dollar's reserve currency status, which historically relied on us running trade deficits. It's all interconnected and tricky.
So putting it all together, what's the economic outlook? Recession, continued growth, muddle through.
Views differ, of course. Callahan saw some signs things might be getting toppy, maybe a downturn ahead.
But he also thought the Fed would react strongly if that happened.
Yeah, he expects a bigger bazooka of monetary easing if there's a serious crisis, like in '08 or 2020.
And potential tax cuts could also stimulate GDP.
That's another factor. So his outlook seemed cautiously bullish, recognizing things could go wrong, black swan events, but...
But the U.S. has resilience. Demand for dollars, debt in our own currency, diverse economy.
Those are supporting factors, yes. He also stressed deregulation is helpful for business. The analogy was the train is running hot, but maybe won't crash.
Okay. So for you, the listener, wrapping your head around this, what's the key takeaway?
A big one is own assets. In this environment of potential persistent inflation and high debt, holding cash or bonds might not be the best strategy for preserving wealth.
And Callahan specifically pointed to Bitcoin.
Yes, as a compelling alternative. Fixed supply, relatively small market cap still, meaning potential for significant appreciation, asymmetric upside. Plus, growing adoption trends, regulatory clarity improving, hash rate climbing.
All signs pointing towards it being a potentially valuable tool.
A tool for wealth preservation, maybe even growth, in an era defined by fiscal dominance. That's the argument.
Okay, so let's try to sum up this deep dive. We've really unpacked fiscal dominance, how government choices on spending and debt are increasingly driving the bus, maybe more than the Fed right now.
We looked at the history, how today's huge debt makes it different from the past, like the 70s.
We saw how deficits fuel inflation through interest payments acting like stimulus, and why that makes the Fed's job harder.
Yeah, and the real difficulties in actually cutting spending, especially entitlements, because of politics and our financialized economy.
And we touched on potential paths forward, the need for real growth, and how something like Bitcoin might fit into fostering long-term savings and innovation.
Which leaves us with a final thought for you, the listener, to chew on.
Given these deep structural challenges of fiscal dominance we've discussed,
What kind of truly innovative solutions, maybe things beyond traditional economics, might we need for long-term stability and prosperity?
and what does all this tell you about the future role of decentralized assets, like Bitcoin, in a world increasingly shaped by government debt?